Exercise 1610. We are asked to record journal entry of income taxes for 2018. There are three elements in journal entry of income taxes. First, income tax payable. Second, deferred taxes. Thirdly, income tax expense. Let's start from the deferred taxes. The problem tells us deferred tax asset account has a balance of $30 million at the end of 2017. And they explain to us how they can get this $30 million. It is the book tax difference $75 million multiplied by 40%. So 40% multiplied by 75 million, you will see $30 million. Why is $75 million of liability for estimated expenses a deferred tax asset? Because expenses is non-cash decrease of income. It's non-cash, so during the year of reporting this expense, we cannot get tax deductible. But later, when the expense are actually paid, cash goes out, then we don't need to pay taxes on those cash outflow. So in the future, we can get tax deductible, and that is deferred tax asset. At the end of 2017, we have deferred tax assets of $30 million. At the end of 2018, we have future deductible amounts $70 million. End of 2017 is the beginning of 2018. We have deferred tax asset at the beginning of the year, and we can calculate deferred tax asset at the end of the year. With the difference between beginning balance and ending balance, we can find out the journal entry amount for deferred tax assets. The deferred tax assets T account beginning of the year, we have $30 million. At the end of the year, 70 million future deductible should be multiplied by 40% to get tax deferred tax asset. So 40% multiplied by 70, $28 million. Therefore, the change during the year is a credit amount, which is a decrease by $2 million. So now we can do the journal entry. First, income tax payable is calculated by 2018 taxable income, 180 million multiplied by 40%. And then we have a deferred tax on the credit side. By $2 million. Finally, to balance the entry with income tax expense. And then it says, assuming it is more likely than not that the deferred tax assets will be realized. When deferred tax asset means future deductible, that's a benefit, then conservative US GAAP will judge whether these future benefits are likely to become true. And here, after the assessment, they said it is more likely than not these deferred tax assets will allow the company to deduct their tax. As a result, the second entry, we don't need a valuation allowance. Simply choose no journal entry is needed. The second requirement says, prepare journal entry to record income taxes for 2018, assuming it is more likely than not that 1/4 of the deferred tax asset will ultimately be realized. Okay, so the second part of this sentence means 1/4 of this $28 million of deferred tax assets will be realized. Then 3/4 of it, of this 28, will not realize. Conservative US GAAP says if it's not likely to be realized, you should charge to income tax expense. But we do not directly reduce deferred tax assets. We reduce deferred tax assets by a valuation account. So 3/4 of this 28th will not be realized. So 28 multiplied by 3 divided by 4. 21 out of this 28 will not be realized. Since we cannot get tax deductible, additional income tax expense should be recorded. In the first journal entry for requirement 2, recording 2018 income taxes, we still have the same journal entry as the first requirement. But the second entry asks us to record valuation allowance for the end of 2018. Second requirement will have this journal entry.